In this video, we will be discussing financial statement ratio analysis. We will be completing 19 ratios in total, so if there is a specific ratio you would like to see, check out the description of this video and click on the relevant timestamp. Ratio analysis can be broken up into 4 categories. First, there are liquidity and efficiency ratios, which measure the company's ability to meet short-term obligations and to efficiently generate revenues. Solvency ratios measure the company's ability to generate future revenues and meet long-term obligations. Profitability ratios measure the company's ability to provide financial rewards to attract and retain financing. And finally, market prospects ratios measure the company's ability to generate positive market expectations. We will be using this income statement and these comparative balance sheets to calculate all of our ratios. We will compute the ratios based on the 2020 values, but some ratios require us to use 2 years for balance sheet items, which is why we also have a 2019 balance sheet. Also, a few ratios require some additional information, which I will provide when needed. We begin with the liquidity ratios. First, we have the current ratio, which is found by taking the current assets and dividing by the current liabilities. We have 205,000 divided by 36,000, which equals 5.69 when rounded to 2 decimals. I will be rounding all ratios to 2 decimals or to the whole percent, unless otherwise specified. A higher current ratio suggests that the company has plenty of resources, current assets, to cover their short-term obligations, current liabilities. For all ratios, the ideal value will depend on multiple factors, such as industry standard, business model, historical trends within the company, and many other factors, so there is no magic number we are looking for, just broad guidelines on what is generally desirable or undesirable. A higher current ratio is usually considered better, but a lower current ratio, especially one closer to 1 or less than 1, can signal that the company may have issues paying for their short-term obligations. 5.69 is a healthy current ratio and signals that this company can easily pay their short-term obligations. Next, we have the acid test ratio, which is essentially just a modified current ratio. Instead of including all current assets, we only include the most liquid current assets in the numerator, the ones that are very easily converted to cash, which include cash itself, short-term investments, and current receivables. The denominator is still current liabilities. For us, we have 169,000 for cash, plus 5,000 in short-term investments, plus 13,000 in current receivables, which is just our accounts receivable, all divided by the $36,000 in current liabilities. This gives us 5.19 for the acid test ratio. The acid test ratio will always be smaller than the current ratio, as the numerator only includes a few select current assets instead of all current assets. Again, a higher acid test ratio is typically better, just like the current ratio, and values near or lower than 1 suggest that the company may have difficulty paying their short-term obligations. The third liquidity ratio we have is the accounts receivable turnover, which can be calculated by taking the net sales and dividing by the average accounts receivable. First, the average accounts receivable is just the average between the 2020 and 2019 amounts, which are 10,000 and 13,000. We can find the average by adding these two values together and dividing by 2, which gives us 11,500. Then we can take the $300,000 of net sales and divide by the 11,500 to get the accounts receivable turnover, which is about 26.09. This means that the accounts receivable average balance of 11,500 is collected about 26.09 times throughout the year. Ideally, the numerator would be net credit sales instead of net total sales, but oftentimes financial statements don't make this distinction. Higher accounts receivable turnover indicates that accounts receivable is generally collected fairly quickly, which is a good thing. Accounts receivable that isn't collected for long periods of time might have a greater chance of becoming uncollectible, so we generally prefer a higher accounts receivable turnover. The fourth liquidity ratio we will look at is inventory turnover, which is found by taking cost of goods sold and dividing by the average inventory. Note that on some income statements, you will see cost of sales instead of cost of goods sold. In that case, you should just use the cost of sales in any ratio requiring cost of goods sold. Our average inventory is 18,000 plus 12,000 divided by 2, which is equal to 15,000. 200,000 divided by 15,000 equals a 13.33 inventory turnover. This means that the company sells its average inventory balance 13.33 times in the year. A low inventory turnover compared to competitors might suggest the company is inefficiently using their assets by holding too much inventory. Also, a ratio that is too high might suggest that inventory is too low, which might cause lost sales to customers if inventory is not available to order. Generally, a high ratio is preferable, as long as the inventory is available to meet customer demand. Our fifth liquidity ratio is days sales uncollected, which is equal to accounts receivable net divided by net sales, multiplied by 365. We have 13,000 divided by 300,000 multiplied by 365, which is equal to 15.82. This means that it takes about 15.82 days on average for this company to collect their accounts receivable balance. Generally, a lower days sales uncollected ratio is better, and suggests the company can more quickly collect the cash from their ending accounts receivable. A company can potentially reduce their days sales uncollected ratio by offering shorter discount periods. The sixth liquidity and efficiency ratio we will look at is days sales in inventory, which is calculated by taking ending inventory divided by cost of goods sold multiplied by 365. For our example, we have 18,000 divided by 200,000 times 365, which equals 32.85. This is the number of days of inventory sales the company has on hand. The company could go 32.85 days without purchasing any new inventory and still meet their sales demand. If this ratio is too low, it might suggest the company is at risk of not meeting their customer demand, especially if there are delays in deliveries for inventory purchases. If this ratio is too high, it might suggest the company is carrying more inventory than necessary. The seventh and final ratio in the liquidity and efficiency category is the total asset turnover, calculated by taking the net sales and dividing by the average total assets. Average total assets in our example are 300,000 plus 320,000 divided by 2, which equals 310,000. The total asset turnover is 300,000 divided by 310,000, which is equal to 0.97. This means that for every $1 in assets, the company has 97 cents of net sales. Higher asset turnover is almost always desirable, but the interpretation is highly dependent on the company's operations and how capital-intensive the industry is that they compete in. More labor-intensive industries might not require as many assets to produce sales, suggesting they will have a higher asset turnover ratio. Typically, lower asset turnover companies will have high profit margins, such as hotels or other industries that sell luxury goods. Similarly, higher asset turnover companies might be okay operating on a lower profit margin, such as grocery stores. Okay, now that we are finished with the liquidity and efficiency ratios, we can move on to the solvency ratios. Remember that solvency ratios measure the company's ability to generate future revenues and meet long-term obligations. The first two ratios go together, and they are the debt and equity ratios. Both ratios divide by total assets, but the numerator changes from total liabilities in the debt ratio to total equity in the equity ratio. For our example, we have 46,000 divided by 300,000, which equals approximately 0.15 or 15% for the debt ratio, and 254,000 divided by 300,000, which equals approximately 0.85 or 85% for the equity ratio. Notice that these two percentages add up to 100% and represent how total assets have been financed, 15% with debt and 85% with equity. A company with a higher debt ratio is said to have high financial leverage, which involves greater risk as liabilities must be repaid, often at regular intervals and with interest, which is not the case for equity financing. Generally, a balance more towards equity is considered less risky, but if the company is able to produce a return higher than the cost of borrowing on their debt obligations, a higher debt ratio might not always be a negative thing. The third solvency ratio we will look at is the debt-to-equity ratio, which takes total liabilities and divides by total equity. For our example, we have 46,000 divided by 254,000, which is equal to 0.18 or 18%. This tells us that total liabilities are 18% of total equity. This tells us a similar story as the previous two ratios, but in a little bit different form, that equity financing is much higher than debt financing for this company. A debt-to-equity ratio of 1, or 100%, suggests that debt and equity financing are equal. The same risks of having a high debt apply as were discussed in the previous two ratios, including the consistent payments and interest that must be paid on debt financing. The fourth and final solvency ratio we will be looking at is the times interest earned, which is equal to the income before interest expense and income taxes divided by the interest expense. For our example, we have 30,000 divided by 2,000, which equals 15. Sometimes the label income before interest expense and income taxes won't show up directly on the income statement. In that case, you may have to take the net income, $23,000 in our case, and add back the income tax expense and the interest expense, which are $5,000 and $2,000, to get the income before interest and income taxes of $30,000. Our value of 15 means that this company earns their interest expense 15 times over. Interest expense is often viewed as a fixed expense as it depends on liabilities and not sales. A times interest earned ratio of 15 suggests that the company can easily cover their interest expense. If the times interest earned ratio falls below 1.5 or 2, that might suggest a higher chance of defaulting on liabilities. Now we move to the third category of ratios, which is profitability. These ratios measure the company's ability to generate income. The first two profitability ratios we will look at are the profit margin and the gross margin ratios. The profit margin is net income divided by net sales, and the gross margin is net sales minus cost of goods sold divided by net sales. For our problem, we have $23,000 divided by $300,000, which is about 0.08 or 8% for the profit margin, and $300,000 minus $200,000 divided by $300,000, which is about 0.33 or 33% for the gross margin. Notice that the numerator of the gross margin ratio is just the gross profit. These two ratios can be interpreted similarly. The profit margin of 8% means that for every $1 in net sales this company has, they have 8 cents in net income. Similarly, the gross margin ratio of 33% means that for every $1 in net sales that this company has, they have 33 cents in gross profit. Businesses would prefer both of these ratios to be higher, although some industries, such as luxury goods, operate at higher margins, whereas others operate with low margins, such as grocery stores. Our next profitability ratio is the return on total assets, which is equal to net income divided by average total assets. The average total assets for our example is $300,000 plus $320,000 divided by 2, which is equal to $310,000. The return on total assets is equal to $23,000 divided by $310,000, which equals about 0.07 or 7%. This means that for every $1 in assets the company has, they're able to generate 7 cents in net income. Having a higher return on total assets is always desirable, but what is typical will vary greatly based on the industry. Next, we have the return on common stockholders' equity, which is equal to net income minus preferred dividends divided by the average common stockholders' equity. To find the average common stockholders' equity, we must first find the common equity in 2020, and then find the common equity in 2019, and then find the average. Common equity in 2020 is the total equity of $254,000 minus the $20,000 in preferred equity, which is equal to $234,000. The common equity in 2019 is the total equity of $244,000 minus the preferred equity of $20,000, which equals $224,000. If there were preferred dividends in arrears, you would need to subtract those two. The average common stockholders' equity is $234,000 plus $224,000 divided by 2, which is equal to $229,000. Many times, companies will not have preferred stock, and if that's the case, you can simply use the average total equity. Assuming that the company has $3,000 in preferred dividends, we can complete the formula. We have $23,000 in net income minus the $3,000 in preferred dividends divided by $229,000, which is equal to 0.09 or 9%. This means that for every $1 common stockholders have invested or retained in the company, 9 cents have been earned in net income. Next, we have the book value per common share, which is equal to shareholders' equity applicable to common shares divided by the number of common shares outstanding. To find the shareholders' equity applicable to common shares, we must take the total shareholders' equity and subtract the preferred stock. For our example, we have $254,000 minus $20,000, which is equal to $234,000 of stockholders' equity applicable to common shares. If you had preferred dividends in arrears, you would need to subtract those too. We can then take this value and divide by the number of shares outstanding. Let's assume there are 20,000 common shares outstanding. 234,000 divided by 20,000 is equal to 11.7. This means that if the company liquidated its balance sheet accounts, then each share would be worth $11.70. Typically, higher values for the book value per common share are desired. Our final profitability ratio is the basic earnings per share, which is found by taking the net income and subtracting the preferred dividends, and then dividing by the weighted average common shares outstanding. In our example, common stock is the same at the beginning and the end of the period. There are 20,000 shares, as we said when we calculated the book value per common share. so this becomes the denominator in our formula. More advanced courses show the calculation of weighted average common shares outstanding when the number of shares changes throughout the period. Companies often list their weighted average common shares outstanding along with the income statement or in the notes to their financial statements. The ratio becomes $23,000 in net income minus the $3,000 in preferred dividends divided by 20,000 shares, which equals 1. This means that the company earns $1 in income for each common share. Generally, a company would prefer to have a higher earnings per share. Finally, we can move to our last category of ratios, which are the market prospects ratios, which incorporate the price of a stock sold on a publicly traded market. In order to compute the market prospects ratios, we need to know the stock price at the company. Let's assume that this company has a stock price of $20. This value won't be listed in the company's financial statements, but can usually be found online through a Google search. The first market prospects ratio is the price earnings or PE ratio, which is found by taking the market price per common share and dividing by the earnings per share. We already found the basic earnings per share to be $1 each, which we will use here as our denominator. The numerator is the $20 market price, so we have 20 divided by 1, which is 20. Analysts use the PE ratio to determine whether or not the stock is under or overpriced. If an investor can identify an underpriced stock, they can invest in it to make profit if the stock were to increase in value to its quote-unquote correct price. Some analysts consider a PE ratio of greater than 20 to mean that the stock is overpriced, meaning that it might fall in value soon. A PE ratio of less than 5 might mean that the stock is underpriced, meaning the price might increase soon. The final ratio we will look at is the dividend yield, calculated by taking the annual cash dividends per common share and dividing by the market price per share. Let's assume this company pays 50 cents in common dividends per share this year. Companies often list their dividends per share along with their income statement, statement of cash flows, or in the notes to the financial statements. The dividend yield is 0.5 divided by the $20 market price per share, which gives us a 0.025 or 2.5% dividend yield. If the stock has a high dividend yield, it might be worth investing in even if you don't believe the stock will increase in value, just to take advantage of the dividend income. Stocks with high dividend yields are often called income stocks. Okay, that wraps up the last of the ratios we will be discussing. The biggest thing to remember is that what makes any given ratio good or bad is dependent on a variety of factors, such as industry standards, business model, historical trends within the company, as well as many other factors. So make sure to keep all of those things in mind when you calculate and interpret financial ratios.